You're listening to The Bill Ferguson Show.
It's an amazing time with the stock market and everything, and you would think that probably my biggest problem would be people calling me in a little bit of a panic. Thankfully, that's not the case. I've had a few people who wanted reassurances that everything is going to be okay, and I do my best for that. And I had one husband and wife team that wanted to talk and readjust their portfolio, and we worked on that. But the vast majority of my clients are doing exactly what I would have expected them to do. Exactly what I want them to do, and that is to send in more money. Not to me. I mean, my billing would go up if you add money because that's how that works, but sending it into TD Ameritrade where all of my clients' accounts are at, in their own names, by the way, not in my name. It's always in your name. People can send money there and add to their portfolio. Typically, the stock market has 10 to 15% short-term corrections every year, twice a year, sometimes 3 times a year. Sometimes you go a year or two and you don't have one. And they're swift and they're annoying and they go back up. The last one we had was in 2018, and I think 2017 might have had 3 of these. I didn't actually check. And those are just kind of the normal part of the business. And every once in a while, a little scary drop or volatility shakes out some of the novices and the people who just don't have the stomach for stock market investing, and we go back up and we continue on. And from 2008, early 2009 until a couple of weeks ago, the market's been pretty much up. Like I said, we've had these corrections. 2018 in the fall, in the fourth quarter, we had a bigger drop, but I ignore those because you should continually add money. If you're farther from retirement, you have no bonds, you just add money to stocks, because that's how you make money in the long run. If you're getting closer to retirement or in retirement, you want to think about how big the cushion needs to be. And it's all about your cash flow, not a fixed percentage number. If someone forces me to pick a number, I'll say 40% because I know that's a nice, safe, conservative number, 40% of your portfolio in bonds. But for some people, the right number is 32%. And for some people, it's been 10% or less, even in retirement, to have in bonds. And that would usually be someone who has a really big portfolio and they take a very small amount out. Because if the market takes a big drop, you can just live off the dividends for a year or two. Or if you can even skip taking money out because you have Social Security and or some pensions, so you don't need the money. You can always take more risk when you don't need the money at all. When you need every penny, that's when you got to be a little careful. However, we are now at the point where from peak to trough, as they like to say in the biz, the stock market's down about 28% as of this recording, and usually drops bigger than 20%, which we really haven't had for a long time, start to entice me. And it may not do anything for you, but remember that one of the most basic fundamental things about investing is buy low, sell high. And of course, as one would expect, as I expect, and as I've experienced over 20 plus years, when the calendar year 2019 ended with a stock market return of 31%, nobody called me or emailed me and said, Phil, I just made too much goddamn money. I want to become more conservative. Because when you're winning, you don't want to stop. It's when you're losing that you do a little soul searching and you want to reevaluate things, because that's kind of scary. And again, if you're long term, you can ignore it. You should ignore it. Don't look away. And I say this knowing that in just a few short days, April 1st, March 31st, statements will come out. And a few days after that, people are going to see their portfolio numbers in print. And it becomes real because it's going to be a lot lower than what it was on 12/31. Although if you go back an entire year, right now anyway, it's about the same as a year ago, give or take. But as humans, and I know I've done this in the past, and I'll probably do it myself, anytime I look at a statement that's lower than the previous quarter, it is disconcerting, to say the least. Just don't panic. Don't do anything stupid. mean, if you thought of a month or so ago of selling some stuff because you just made too much money for too many years, great. And for some clients, I've done that. Historically, the cushion was 10 to 12 years, and then I went to 11 to 13, and now it's 12 to 14. So I'm going to change that a little bit. I'm going to take one of those years off. You don't need to be 12 to 14 years in your cushion anymore. You can go to 11 to 13. And yes, this is a minor adjustment back towards normal because we're not trending over the long-term return of 10% over the last 3 to 5 years anymore. Does it mean it's going to go up? No. Does it mean it's going to go down? No, I don't know. Okay, I don't know, but I do know that when the market is down 28, 30%, we're starting to get into unusual territory. And I was looking at this article on CNBC, and I guess the title of it is Based on History, the Stock Market is Pricing in a Recession and Maybe Something More Onerous. Nice word. And it goes through some of the statistics of how big peak to trough drops have been. And so, like I said, right now for the S&P 500, we're at about 30% down from the peak to where we are today. I don't know that this is the bottom. It might be more, but we're down 30% already. In 08 into 09, it was down 57% over a period from 07 through 08 and through 09. The 2001 was down 49%. Early 90s was down 20%. Early 80s was down 27%. A couple of years earlier in the 80s, it was down 17. In the 70s, it was down 48%. Again, 69 and 70s, 36%. 14% in the early 60s. Late 50s, 21%. Early 50s, 15%. So you can see that out of all these recession drops in the stock market, we're now at the point where 30% is kind of in the ballpark. It's not the worst. It still may end up being the worst, but it's the time where I'm a little more interested in adding money. Now, if your job is at risk, if your income is at risk because of the fuckery of the U.S. government, whether you think it's good or bad, or whether Trump screwed the pooch for 6 weeks while this came around us and it's going to get a lot worse, if you think it's going to go a lot lower, then maybe you're not so motivated to put some cash in. But at a 30% discount compared to where it was a month ago, I'm starting to get a little excited. I'm starting to think maybe it's time to throw in some money. So this is not a generic across the board, change your portfolio advice, but this is if you happen to be so blessed, and yes, I use that word on purpose. If you happen to be so blessed that you have $50,000 lingering in a checking or savings account and you've been too stupid to put it to work in the stock market, yeah, you won. You just hit the lottery. Now, if there's any concern about your income or cash flow or losing your job or making less because of the economic uncertainty of these times, leave it where it is. But if you feel pretty safe and secure and you can live without it for years to come, it might be a time to add a little extra money to your portfolio. Don't do anything stupid. I'm not talking about remortgaging your house and taking out cash or getting a second loan or borrowing money at 22% off your credit card. But if you had money you kept kind of meaning to get around to putting into the stock market, and you even thought about it in February or January or last year, and you thought maybe the market got a little ahead of itself and now it's 30% off from where it was a month ago, might be a nice time. Now, if you put it in now and the market goes down 20%, let's say you put in 50,000, it goes down 20%, of course you lost $10,000. But of course, eventually it goes back up. That's why this has to be money you don't need. I'm not talking about money that you might want to put on a house in 2 or 3 years. I'm talking about money for retirement. Again, long-term investing. And think of it as a little bit of a sale. Now, if you want to be a little more adventuresome, let me check this here. One of the funds that I use that has just gone down dramatically is, let's see, what is it here? It is the Vanguard Small Cap Value Fund. Now, thankfully, it's generally been a small portion of portfolios, but if you want to take a little bit more of a gamble, this is something you could add money to specifically. So instead of the S&P 500 or the total stock market or a couple of different funds that you have, this segment of investing has done horribly, absolutely terrible. And I think as of the time of this recording, it is down 43% year to date. 43% year to date. It's funny, it's down 42% in 3 months and down 42%, 42.5% in 1 month. And yesterday, it was down 11%. I'm much more confident that this is an overreaction and that it being down 40-something% is a good opportunity. But of course, this is a riskier kind of thing. And again, I'm not going to sell everything and put it in this one fund because it's on the worst, but it's now more interesting to me. It's more likely, I think, because of regression to the mean, to do well in the future. So if you have a $100,000 portfolio and you've got an extra $5,000 you can add, this might be a place where you could add it. If you have $1 million portfolio and you have $100,000 in your bank account, yay for you. That's a whole bunch of money. Maybe you could put some of it here or all of it here. It's just something to think about. It's an idea because over the last couple years, as we've made a lot of money, we've gone to slightly more conservative positions. We've beefed up bonds. We've extended the length of the cushion from 10 to 12 all the way out to 12 to 14, which I'm now going to step back by 1 year. So you only need 11 to 13 years of cushion. It's the general guideline. If you're more conservative, it can still be bigger. If you're more aggressive, it can be a little smaller. And it's a possibility where you can add money. You might want to add it, and you might want to add it to somewhere here. Now, the next step, again, this is for someone who is hopefully farther away from retirement, has more money than what's necessary. They're doing well, and they're really secure about their job. And they're really secure about their job over the next couple of years. It is possible that if you have something like 30% of your portfolio in the cushion because you're 3 or 4 years out from retirement and for whatever reason you've decided or we've decided together, if you're a client, that that's the right amount, that you could trim that sum and add that to stocks. Again, it's a rebalancing. And in part, the rebalancing could become automatic if you're rebalancing once a year. Maybe you throw in an extra rebalance now. The stocks have fallen, the bonds have stayed the same. Therefore, they become a bigger part of your portfolio than maybe you wanted. It's a nice time to rebalance. But you can overbalance. Again, not right for everybody. If you're doing this on your own, just something to think about. If you've got questions about how that might work, you can email me, phil@polarisfinancialplanning.com. If I get buried in emails, I might have a hard time getting back to you. If you are already a client of Phil of Polaris Financial Planning and you want to discuss this in detail and contemplate your future, and I haven't called you to talk about it already, give me a call. Send me an email, and we can either talk about it then or have some discussions about it and set up a time. And maybe in the meantime, the stock market jumps 20% and we missed out on the sale. I'm not so sure that's going to happen. I think we're going to be headed for some rough times. I think it's very likely we're going to have a recession, and I don't know which way the market's going to go, but I wouldn't be surprised if it continues to go down some more for a while. And, like I said, this is a long-term thing. So if that sounds like you and you feel particularly risky or risk tolerant and you want to take some of your portfolio or some of your cash and add it to stocks or particular stock funds that have done the worst, at least as far as index funds. And this doesn't work for just generally managed funds. I mean, if you have 10 managed funds in your portfolio and you look at those 10 funds and you pick the one that's done the shittiest and add money to it, I don't like that idea at all. There's no indication that the shittiest fund is going to become the better fund in the future. But with large market segments that I use from Vanguard with their index funds, large cap growth and value, mid cap growth and value, small cap growth and value, those funds do have regression to the mean historically. Does not necessarily mean it works this time, but something to think about. So if that's something that you like the idea of it, let me know. If you've just had too much volatility and you're done and you want to reduce your stocks, I will recommend against it right now, but you can talk me into it. So just let me know what you want to do if you're a client and you just happen to be a regular listener to their show. If you've been thinking about hiring an advisor and you have over $1 million, because that's my current minimum, you can also contact me again, phil@polarisfinancialplanning.com, and we can see if we can work something out. I'd like to wrap up by telling you I'll see you out there on the road somewhere like I normally do, but I'm not gonna, because I'm not going out. I'm not going out any more than I should or I can, and I don't think you should go out if at all possible. Stay safe, stay well, try to not interact with more people than you have to, and hopefully in a few months we can find some medicines that can help people recover from this virus faster, and we can keep it at a moderate level. I'm not optimistic, by the way, but maybe we can. And 12 to 18 months from now, we end up with a vaccine and we can all go back to normal society. But in the meantime, we're going to have to limit our movements when we can. I don't know how else to do that, but trying not to go out and be in big crowds. So conferences and a lot of the fun stuff that we do, we're just going to have to set that aside for a while, I think. I know some people really, really hate this idea. And we'll see, I guess. We'll see how it works. I've looked at the last few days in Italy. While the numbers keep going up, they've been going up about 9, 10, 11% per day. And before today, when the new tests started kicking in, because the government finally got its shit together and delivered tests, even with limited number of tests available, the cases in the United States was growing at 25% per day, not 10 or 11 like Italy is. Will Italy make the corner, turn the corner, flatten the curve, whatever they're going to do? I don't know. I really hope so. I just wish it magically all goes away, but I don't know that it is. Anyway, I'm rambling. Thank you for listening to the Phil Ferguson Show. And again, if you want to talk, just let me know. And until we get past the virus and I can see you again, ciao.